Imagine being asked to pay, nearly 100 times what a company actually makes in an entire year.
Right, and you aren't buying a proven software product with, like, steady, predictable cash flows either.
No, exactly. You are basically being asked to fund a promise of achieving artificial general intelligence and, well, building massive data centers floating in the vacuum of orbit.
Yeah, you're being asked to price in a reality that simply hasn't arrived yet. And more importantly, you're being asked to pay retail prices for that unwritten future, like today.
And that future is hitting the market right now. So welcome to a financial candy special from Claire and Horatio, the Trillion-Dollar IPO Machine.
Glad to be here for this one.
Today we are examining a massive stack of SEC S1 filings, financial analysis reports, and some really fascinating academic research from May and June of 2026.
Right, and our mission with this analysis is to really dissect the impending tidal wave of mega IPOs.
Yeah, we are looking at SpaceX, OpenAI, and Anthropic preparing to hit the public markets at valuations that honestly rival the GDP of entire countries.
I mean, we have to acknowledge these are real companies, right? With undeniable breakthroughs. The rockets are landing, the satellite internet is connecting remote regions.
The AI models are autonomously coding.
Exactly. The technology is not vaporware. But the capital expenditure required to keep these infrastructure companies alive is just unprecedented in modern financial history.
So we have to figure out if public markets are being offered a genuine, ground floor ticket to a sci-fi future.
Or if everyday investors are simply being used as exit liquidity for venture capitalists who have already marked up the dream to astronomical heights.
Right. So let's look at the sheer scale of the capital these companies are trying to pull from the public because, honestly, the numbers defy traditional market logic.
They really do.
SpaceX is targeting a June 12, 2026 IPO, and they are looking to raise $75 billion from the public market.
Which is just a staggering ask.
It is. And the valuation they're attaching to this offering is between $1.75 trillion and $2 trillion.
And they aren't even bothering with the traditional, price range games that investment banks usually play to build momentum.
No, they simply set a flat target of $135 a share and just dared the market to meet it.
And the AI giants are stepping right in behind them. I mean, OpenAI recently raised $122 billion in the private markets.
At an $852 billion valuation, right?
Yep, with Anthropic closing a Series H round at a massive $965 billion valuation.
But 1.75 trillion isn't a number you arrive at by looking at current bank accounts or tangible assets.
No, not at all. To understand that price tag, you have to look at the massive gap between what these companies are worth on paper and what they actually earn in reality.
Right, the trailing revenue.
Exactly. In finance, trailing revenue is just the total sales a company brought in over the previous 12 months. And according to their S1 filing, SpaceX's 2025 trailing revenue was $18.7 billion.
Okay, so a $1.75 trillion valuation prices the company at roughly 94 times its past year's sales.
94 times.
Yeah. To put that 94x multiplier into perspective, look at a mature, highly successful public tech proxy like Tesla. Tesla trades at roughly 16 times its revenue.
Right, 16 versus 94.
Yeah. For SpaceX to be on trend with a peer like Tesla, they would need to be generating roughly $150 to $175 billion in annual revenue right now.
Which they are nowhere near.
Right. It's like buying a rental house for 100 times the annual rent it brings in. You are betting entirely on the neighborhood turning into Manhattan.
That's a great analogy. When you buy in at a 1.75 trillion valuation, you aren't paying for the company SpaceX is today. You're paying for the company they might be a decade from now.
Assuming they execute a flawless business plan.
Exactly. Without a single catastrophic engineering failure.
So how do these companies possibly justify these multiples to institutional investors? I mean, what is the pitch?
Well, the mechanism they use is called TAM storytelling, total addressable market. They do not justify the price with current cash flows. They are pricing the stock for heroic future growth.
Right. The pitch is that current revenue is just a rounding error compared to what's coming.
Yeah, exactly. They're saying once our technology reshapes the entire global economy, this price will look like a bargain.
And the TAM storytelling in the SpaceX S1 filing it's almost surreal to read.
Oh, it really is.
They claim a quantifiable total addressable market of $28.5 trillion. They actually call it the largest actionable TAM in human history.
But 93% of that $28.5 trillion relies on a market that essentially does not exist yet.
Right. Space-based AI infrastructure. Since SpaceX merged with xAI back in February, they aren't just pitching themselves as a rocket company or even an internet provider anymore.
No, the core pitch is launching up to 1 million data centers into orbit.
Which sounds crazy, but the engineering logic behind that pitch is actually kind of brilliant.
It is because it targets the severe bottlenecks of the current AI boom down here on Earth.
Right. Power and cooling. It's exactly. Terrestrial AI data centers are totally gridlocked by power generation and thermal cooling. On Earth, securing the gigawatts of power you need to train a massive AI model takes years of permitting, grid upgrades, and, local negotiations,
And then once you power those servers, you have to cool them.
which requires millions of gallons of water.
Yeah. But by putting these data centers in sun-synchronous orbits, SpaceX claims they can harvest constant, uninterrupted solar energy.
Without a night cycle.
Right. While utilizing the near absolute zero temperature of the vacuum of space to naturally cool the hardware.
It theoretically solves the terrestrial bottlenecks, but the cost to build that orbital infrastructure is bleeding them out on Earth today.
Yeah, the filings show a really stark contrast in their business units. The Starlink satellite internet division is a proven, functioning business. I mean, it generated a $4.4 billion operating profit in 2025.
Which is fantastic, but the xAI division recorded a massive $6.4 billion loss.
Right. That single AI division dragged the entirety of SpaceX down to a $4.94 billion net loss for the year. And the burn rate is accelerating.
Yeah, in just the first quarter of 2026 alone, they saw a $4.28 billion net loss. The capital required to build the hardware before it ever leaves the atmosphere is just staggering.
Well, the terrestrial costs are staggering because they're competing in a compute arms race.
Yeah.
But the demand side of that equation is also very real, which is what makes this market so difficult to evaluate.
Because it's not just vaporware.
No. Anthropic literally signed a contract in May 2026 to pay SpaceX $1.25 billion a month.
A month.
Yeah, a month, for 3 years, just to use SpaceX's terrestrial Colossus data center. And Anthropic actually has the cash flow to sustain that. Their annualized revenue hit $47 billion in May, jumping from $14 billion just 3 months prior.
And we really need to understand how that revenue jump happened because it's the core justification for these 100x multiples.
Right.
Anthropic's AI coding agent, Claude Code, is generating $2.5 billion in annualized billings on its own. It is authoring an estimated 4% of all public GitHub commits worldwide.
Think about that. When a single piece of software is autonomously writing 4% of the world's public code, you are fundamentally shifting the economics of human labor.
Right. It's not just a software tool anymore. It's a synthetic workforce.
Exactly. That is why the market is willing to entertain these valuations. The buyers believe they are purchasing a stake in the replacement of global knowledge work.
And that synthetic workforce is undeniably transformative. But tracing the flow of capital between these megacorporations reveals a massive systemic risk.
A circular economy risk.
Yeah. Amazon and Google pour tens of billions of dollars into Anthropic. In return, they act as Anthropic's primary cloud providers, so a portion of that money flows right back to them.
Right. Then Anthropic takes those billions and pays SpaceX for massive compute contracts.
And SpaceX takes that cash and buys specialized chips and power infrastructure. It operates like a massive corporate company town.
Yeah, everyone is trading the same capital back and forth to buy each other's products. Chips, power, data centers, compute.
It creates this illusion of massive autonomous GDP growth. But if the external venture capital stops flowing in to prime the pump, that entire circular economy could just seize up.
Absolutely. If one major player can't raise their next round, the revenue for the other 3 players instantly collapses.
Which feels very familiar.
Oh, we saw an identical dynamic during the telecom and fiber optic build-outs of the late 90s dot-com bubble.
Right.
Companies were trading server capacity and funding each other's capital expenditures to build out the internet's backbone. The infrastructure they built was very real. I mean, we are using that dark fiber network right now.
But the early investors who financed that massive capex burn got wiped out before the cash flows ever materialized.
Exactly. The companies collapsed under their own debt loads, even though the technology ultimately changed the world. Pricing a company for flawless execution leaves zero margin for the brutal financial realities of building physical infrastructure.
Which brings us to how the broader market is reacting to this speculative frenzy right now. But before we break down the academic research proving this decoupling of fundamentals, a quick note.
Sure.
We are examining some deep financial mechanics today. And if you enjoy analyzing these kinds of complex systems, Clara and Horatio also offers brain candy, debate candy, news briefings, classic companions, and classic audiobooks to keep your mind sharp.
Always good to keep the mind sharp. So looking at how the market is behaving, there's a severe decoupling happening between a company's actual financial health and its stock price.
Yeah, this 2025 academic paper from UMI University was fascinating. It's titled Beyond Fundamentals.
Right, they tracked the tech sector from 2022 to 2024, essentially in the wake of the ChatGPT launch. And the researchers tracked a statistical metric called adjusted R-squared.
And for anyone unfamiliar, adjusted R-squared is essentially a reality check for the stock market. It measures how much of a company's stock price can be explained by the boring foundational numbers on its balance sheet. You know, things like book value, revenue, capital expenditures.
Basically, if a company's stock goes up, mostly because its profits went up, the R-squared value is high. It means the math still matters.
Right. So what did this study find?
Well, for non-tech stocks over that period, that R-squared value stayed perfectly stable around 0.7, meaning the balance sheet still governed the stock price. But for tech stocks during the AI boom, that value plummeted from 0.47 to 0.38.
Wow. So the market effectively just stopped caring about the fundamentals.
Completely. The researchers found that indicators of speculative sentiment, like how much hype surrounded an IPO in its first day of trading, emerged as the primary drivers of valuation.
Investors are trading on the narrative of the future, entirely decoupled from the financial realities of the present.
And because everyday investors can't just call up a broker and buy private SpaceX or OpenAI shares, that speculative hype is flooding into what we call the shadow market.
People are so desperate for any exposure to these companies that they are buying proxy stocks and investing in special purpose vehicles or SPVs.
Let's actually break down how an SPV mechanism distorts these valuations.
Yeah, please.
An SPV is essentially a financial shell company created for one specific purpose: to pool money from multiple investors, to buy a single asset like a massive block of private SpaceX shares.
Okay.
But when retail demand for that SPV goes parabolic, the price of the SPV shares detaches completely from the value of the underlying asset it holds.
And we saw this vividly with the Destiny Tech 100 fund, ticker DXYZ. It holds a direct equity stake in SpaceX. But the retail demand to get a piece of SpaceX was so intense that the fund began trading at a 173% premium over its net asset value.
Which is wild. You had retail investors willingly paying almost $3 for every $1 of actual SpaceX stock held by the fund.
Right. The underlying asset didn't become more valuable. The mere access to it became a speculative commodity.
And this creates a bizarre ripple effect across the entire public market. I mean, Alphabet's original $1 billion investment in SpaceX back in 2015 is now estimated to be worth $64 billion.
Yeah, and EchoStar received $11 billion in SpaceX stock simply for trading some Spectrum licenses. We even saw a tiny furniture firm called XMax and an aviation company called Jet.ai experience these massive artificial spikes in their market caps.
Just because they happen to hold minor SPV stakes in SpaceX.
Right. Trading algorithms and retail investors flooded into their stocks just to catch a piece of the SpaceX halo.
The entire ecosystem is built on a house of cards dictated by private markups. And we already got a taste of what happens when that illusion slips.
You're talking about SoftBank.
Yeah. SoftBank's stock recently dropped 10% simply because OpenAI missed some internal financial targets. SoftBank has committed over $64 billion to OpenAI.
Wow. And Zoom's balance sheet is similarly tied up in its Anthropic stake.
Exactly. So if these AI giants are forced to correct their valuations downward before they IPO, it won't just hurt venture capitalists. It will instantly wipe billions off the market caps of their public backers.
Okay, so with these astronomical valuations, the accelerating burn rates, and a market trading purely on momentum, we have to look at the actual mechanics of the deal being offered to everyday investors in these upcoming IPOs.
Yeah, let's look at the allocation strategy, because for the SpaceX IPO, it is highly unusual. They are planning to allocate 30% of their IPO shares directly to retail investors.
Which is huge. That is roughly 3 times the standard retail allocation for a mega cap offering. I mean, the CFO is on record saying retail will be a bigger part of this than any IPO in history.
And a 30% retail allocation sounds democratizing, right?
Yeah. Right.
Like they are finally letting the public in on the ground floor instead of reserving all the gains for Wall Street.
Right.
But you have to read the fine print regarding corporate governance. Who is actually keeping control of the steering wheel?
This is the kicker. The S-1 filing outlines a dual-class share structure. Elon Musk will own about 42% of the actual equity, but he will hold super voting shares that give him a staggering 85% of the voting control.
85%. And Anthropic and OpenAI have constructed similar structural moats.
Yeah.
Anthropic is a public benefit corporation governed by a long-term benefit trust. That essentially holds absolute appointment power over board seats, regardless of what the shareholders want.
And Sam Altman maintains strict control over OpenAI's direction. So you are being asked to hand over your capital to fund these massive, money-losing infrastructure build-outs, but you are explicitly being stripped of corporate democracy.
It is an incredible asymmetry of risk. Think about what you are actually funding. If SpaceX's Starship suffers an engineering failure, say the second stage heat shield degrades and prevents the rapid reusability that their future profit margins entirely depend on, the public investor absorbs that financial blow.
Right, and if Anthropic's models hit a capability wall and fail to outpace open source competitors, you absorb the loss.
Yet, if the company decides to pivot, burn through its cash reserves, or entirely change its business model, your voting power is mathematically irrelevant.
You're providing the fuel, but you have absolutely no say in the destination.
And the timing of this risk transfer is what really exposes the vulnerability of the retail investor.
The lockups.
Yes. The S-1 filing outlines a staggered lockup schedule. A lockup period is a contractual pause that prevents company insiders and early investors from dumping all their shares on the open market the moment the company goes public.
It prevents an immediate crash.
Right. But that dam eventually breaks. For SpaceX, the hard cliff hits 180 days post-IPO.
And that 180-day cliff lands right in December 2026. At that exact moment, early venture capitalists, insiders, and the banking syndicate are finally permitted to liquidate their holdings.
Keep in mind, these are the entities that bought into SpaceX when it was valued at a tiny fraction of $1.75 trillion. They're sitting on historic paper profits.
Yeah, so if the market is relying entirely on the future promise of orbital data centers, but the current reality is a massive cash burn, December 2026 becomes a ticking clock.
Exactly. The retail investors provided the billions in fresh capital to keep the lights on, while the insiders, who marked the valuation up to $1.75 trillion, used that new liquidity to quietly exit their positions. It's like throwing a massive party where the retail investors pay the cover charge and the VIPs are looking for the back exit.
So as we wrap this up, this wave of mega IPOs really represents a structural handoff from private venture capital to public equities.
It does. The venture capital ecosystem has stretched itself to the absolute limit. They've funded these companies as far as they can, but the hundreds of billions of dollars required to build out 1 million orbital data centers and, achieve artificial general intelligence, that requires the incredibly deep pockets of the public market.
And the underlying businesses are remarkable. I mean, Starlink is carving out a massive, highly profitable monopoly in satellite internet. Claude Code is autonomously rewriting the fabric of global software. The technology is real.
It's real and likely transformative. But the valuations, pricing a company at nearly 100 times its trailing revenue, demand a flawless execution of a science fiction future that simply hasn't happened yet.
Historically, the public market was a place where a company went after it had proven its business model. You build a cash-generating engine, and you went public to raise the funds to scale it.
Right. Today, the dynamic is completely inverted. Public markets are being asked to fund the most capital-intensive, speculative infrastructure experiment in human history.
Which really forces us to ask a fundamental question about the role of public exchanges. Are they meant to be utility providers for the future of humanity, expected to finance technological progress regardless of the financial cost to the everyday shareholder?
If those orbital data centers take an extra decade to become profitable, these companies might still reshape human civilization. But the investors buying the 2026 IPO could lose everything in the process. The infrastructure may change the world, but the people who pay for the cement rarely get to live in the penthouse.
Something to think about. For more financial candy, brain candy, news briefings, and classic audiobooks, visit claranhoratio.com.